Well, Happy, it's good to have you back. And this time I'm going to go a little bit more specific. I don't need your age. If you don't mind giving us a general idea, like I'm less, 30 or younger, or I'm 40 or younger, that's fine, but you don't have to. My point is, what I've done is invest in the resource sector for most of my life. From the first time I learned about stock investing and investing in general, I kind of got the gold bug early. And I found out about, penny mining shares, which is, in a lot of ways, it's a good way to go broke. It's really about timing. Depends how hot the sector is. But here's my point. I've taught from the beginning that you should own the physical metal first. And after that's accomplished, then it's up to you if you want to gain leverage or not. It's been my vast experience. The best way to gain leverage is through the mining sector. So how does Happy invest in the precious metals?
Yeah, I guess originally I was split between the Sprott Silver ETF, PSLV, and SLV options. If you go back and read my original post, and I have come around to thinking that holding physical in your own possession in your house to some degree is a good idea. It reduces all counterparty risk. I'm maybe not as concerned about that as some others. But I really convinced myself just looking at actually the potential returns of say PSLV versus physical silver in your own home. And essentially, the higher you think silver is going to go and the longer it's going to take to get there, the more the math starts tilting in the favor of physical, even at these relatively high percentage premiums on those physical products. So, I don't know the actual duration of this trade. I might be here sitting with an extremely high allocation to silver plays for 8 years, in which case the physical I own could actually outperform PSLV over that period. Now, if you want to trade frequently, PSLV just wins hands down. Or if you think this move is coming extremely fast, and then you're going to want to exit and say re-enter a year later and then write it again, PSLV again wins that one. Or if you just think that, say, silver is going to $100 over the decade rather than $200 or $500, an ETF like PSLV could win in that situation again. And then there is the more doomsday prepper arguments. In terms of total collapse of the entire financial system, you have something that's a store of value. I'm not as into that situation. I really convinced myself to buy some physical based on kind of the mathematical uncertainty of the returns, and it's just fun, honestly. Like, I really like the designs and feel of it. It's a lot more fun than holding PSLV, and there is something just truly carnal and barbaric in our nature that I think when you are touching physical gold or silver, you get somewhat addicted to it. I definitely did not necessarily buy into that when I heard people arguing in favor of physical silver early on in this movement. There's a lot of people who say if it's not in your hands, you don't own it. And I was like, that's some precious metal dealer propaganda that they're being fed. And that there's really no reason to ever buy physical over something like an ETF that gives you much greater liquidity. But I do agree with their assessment that people who buy physical are going to get much more addicted to buying precious metals than people who are holding it as an allocation. That's just a percentage of their portfolio on the screen. So I definitely do buy into that narrative. I don't knock people buying physical. it's really just based on your own assumptions about the future, which way you want to go. One of the things I talked about with you early on was just the nature of 1,000-ounce bars really being the actual market that's traded, that we're all tracking every day, and which all these smaller products trade off of. So in terms of, really where we need to create early momentum is in that market. So it's tough because the most dedicated people in the movement are buying the smaller coins and bars. So they're there first. But in terms of getting the price to move higher, ideally we would be buying the 1,000-ounce bars first to get the market moving. So back to your original question though, I own PSLV, I own some physical, and then I have options on SILJ at various expirations. I used to have options on SLV. I don't do that anymore just because I kind of despise SLV now. I have had options on First Majestic before. The options part of it is the, it's just a fun part to me that I move around much more frequently. But otherwise, it is more of a core holding in PSLV with some physical. So that's kind of how I'm doing it.
Well, thank you for that. I think it's a pretty good approach. Again, we're, look at all aspects. We talk about the ETFs and the merits of PSLV versus SLV. Of course, I've advocated physical for a lot of reasons. I'm happy to hear that you, I'll say, came around to the physical aspect. I remember as a kid, and I used to get 25 cents a week, and it was 90% silver coins, and then it changed when I was 11. But I remember the first time I got a silver dollar, even though those quarters were cool, or it's just money, to buy something. I didn't think about silver. I mean, I'm a kid. But for some reason, I think I was around 13 when I got my first silver dollar. For some reason, that word dollar was in my hand, that weight of silver, and it just looked cool, and it felt cool. And it seemed to have substance. And, I don't want to be too dramatic here, but I do remember that silver dollar. Of course, these days, so few people in your age group have even ever seen a silver dollar, let alone hold one or own one. So there's something, and of course, I am biased as all get out, but there's something about real intrinsic value that you kind of intuitively or instinctively know. So I'd like to go a little bit further on with percentages. I mean, I'd like to know if you are willing to tell us kind of, are you like all in silver, or are you diversified, or what's your thoughts on, let's say, the younger generation, let's say 35 and younger, being able to take more risk gently because they've got a lot of years left to live, and we're in what I would consider very precarious times with the inflation drum being beat pretty hard. What do you do, and what would you say to your fellow generation way to approach?
Yeah, so personally, I have like a 401k through my employer that I'm always putting money into. I actually have no precious metals options within that, and so that I kind of see as just my completely hands-off kind of investments. And then over my early working years so far, I have been putting some money into another investment account that I control 100%, and that's what I'm playing with all of these other plays. And at this point, that's all in various silver things. So in terms of the money I'm controlling actively, it's 100% in silver plays. If you just want to look at broad portfolio allocation, I am a fan of Dragon Portfolio. I don't know if you've heard of that from Artemis Investments. I read, so they have a paper, you can go look it up, that if you look at Dragon Portfolio Artemis, it shows, they've back tested all of these different allocation strategies across different asset classes for, I think 130, 120 years or so, and basically said if you wanted to have a strategy that would last through all different types of time periods forever and produce consistent generational wealth over time, what would your strategy need to be? And I think they recommend somewhere in the 15 to 20% range of allocation to gold and silver. And that is really to protect during high inflationary time periods, and really, and it all, they actually offer a fund now that does this strategy. We're advertising for them, I guess, but it does advocate for rebalancing this portfolio constantly, and it also includes equities, commodity trend, which you can read about if you go look at it. So that one's kind of parallel somewhat to gold and silver. It also has a long vol component, which is basically stock market crash insurance beyond gold or silver. It also has a fixed income REITs component. This thing has had very good returns over time, but you need every piece of that for the strategy to work. They tested several other asset classes as well to see if it would optimize, and that allocation outperformed by far. But if you strip out gold and silver from it, it does not outperform in the way that it did, because of those few decades throughout history where inflation has been a major concern. Your maximum drawdown in terms of your real return just gets absolutely eviscerated without having gold or silver. So if I was talking to, say, like my parents, I want them to have like 20% or even more, because I am very convinced that this is one of those higher inflation worry decades. I think it will massively outperform. So I'm comfortable going to very high allocation to the thing I'm very dedicated and convinced by. But in terms of, you want to tell somebody else, and if you're wrong, but they're not going to lose all their money, or it's going to jeopardize them in some way, I would say 10 to 20% is my general recommendation. Young people like myself who are risk takers, who like to research, have your money to retire at 65, but then if you want to try to retire much earlier, potentially through active investing, you can go anywhere from 0 to 100%. It's just your choice. That's kind of how I see it.
Well, thank you for that. I want to add on to it. First of all, there's a study done by Ibison and Associates, and it was paid for by BMG Group, Nick Barashef, who runs a bullion fund in Canada. And in the study, it showed 15% to be the best for all seasons. And then during certain, let's say, situations where there was higher inflation, it moved it up to about 20%. There's also a Harvard study that I can't find, so I don't know what the allocation was, but it proved, as you said, with this Artemis study, the Dragon one, that you have to have precious metals and to have maximum return in your portfolio. And lastly, someone that I know you spoke with, and maybe on the next interview we'll talk about it, but Jeffrey Christian, as much as he is a, let's say, controversial spokesperson for the precious metals industry, I've got to be fair. Jeff has spoken, I think, at almost every silver summit that's ever been held. I've known him for years. And he did a study, CPM Group did a study from 1968 on. So right before the close of the gold window by a few years, 3 years or so after the silver was taken out of the coinage. From that point forward, the best allocation for precious metals or Duncan mining shares was 25%. So, and he said that. That I'm not certain.
Sorry, I don't want to interrupt. Do you want to finish your thought?
Final word. I'll just say a couple more sentences.
Okay.
So you've got these studies that are known, by very few of us, but I think if the the certified investment professionals, certified financial planners in the U.S. and their equivalent in Canada, actually had this information and said, you know what, I want to maximize Mr. Client, Mrs. Client, your return, then they would put precious metals in there, obviously, but they don't. So let me turn it back over to you, Happy.
Yeah, so I guess also to be fair and objective, even as someone who is currently raving pro precious metals and silver specifically, I personally would not trust a study that would start in 1968. I think that's if you look at just normal retirement returns over time, I think 68 or 69 is perhaps one of the worst years ever to retire, because sequence of returns risk, you just got absolutely eaten alive by inflation the next decade. So if you're going to start the analysis with the decade where precious metals perhaps performed best since they started freely trading, I would say that's probably biased towards having a higher precious metals allocation versus a study that looks at 1900 and forward. So a very large variety of time periods. And just looking at all of the individual, say 40-year periods or something like that. And I say that as someone who thinks, you should have a very high allocation this decade if you're actively trading. 25% sounds totally fine to me. I just wanted to point that out. In terms of also just another comment on why family office, and not family office hedge fund, family office the way that Archegos is described. I'm just talking wealth management, the wealth management industry for the 80th to 99th percentile type of wealth in America. They're pretty much all equities and fixed income, simply out of inertia and bias, looking at studies from say 1980 and forward. It's hard to put an allocation to something that has not necessarily performed as well over the study period. And their studies are biased because a lot of them start in 1980, which was a peak for precious metals. So they have the opposite of that CPM study, where their sequence of returns starts with terrible performance for precious metals, thus biasing them lower. And then even more so than that, I'm assuming they have some kind of academic approach to it. Most of them don't. They're just, salesmen, essentially. They just want to keep up with everybody else. And you end up probably losing clients faster if you underperform than you gain them if you outperform. So everyone's playing it conservative against their peers and basically just copying each other's strategies when you're talking about basic wealth management among, wealth that is middle to upper middle class type of wealth in America. It's just very standardized. Most of those wealth managers aren't going to actually care about protecting you at all. They just want to have your portfolio perform in line with the shop next door so that you don't move to them and they can keep collecting their annual fee. So I think they're going to be sorely mistaken in their portfolio allocation. I think people will not be very happy with the underperformance of their portfolios as equities and bonds are correlated in their declines this decade, especially, their declines relative to gold and silver. Nominally, if inflation gets bad, equities aren't necessarily going to crash, but they're going to drastically underperform the scarcity asset plays such as gold and silver.
Thank you for that. And you just proved to everyone, at least to me, that you are a very good thinker. And I agree. You gave both examples of why 1968 might be biased one way, and then you gave the other example why 1980 might be biased the other way. That's why, going back, I think a previous interview I talked about the Jastrom study, which is over centuries. So you get a much broader perspective of what gold does over many centuries and what silver does over many centuries. But we're going to go ahead and stop there. I'm looking forward to speaking with you again. Do you have anything that you'd like to say the silver community as far as where to find you, like on Wall Street Silver, or?
You know, I'm an active online commenter. You know, I tend to post on Reddit when I have a longer, more collected thought I want to, you know, tell the world. But then my shorter blurbs that I tweet out all the time. Again, I said tweet, you know, I'm on Twitter as well. So I'm the Happy Hawaiian on Twitter. If you're looking at my handle specifically, there's no E in the. And on Reddit, I'm just the Happy Hawaiian. Those are kind of the only two places I'm active on the internet currently. But yeah, that's where people can find me. And then I'll also say, and you can put this in one of the segments somewhere, maybe the first one, that I'm very grateful that you picked up the phone the first time I called you. Shortly after my first post, I had, you know, not spoken to really anybody who's, say, like a bigger name or a longstanding expert in the field. And you really helped me to get my feet under myself in terms of understanding this market specifically much quicker than I may have done otherwise. So, you know, you're thanking me for helping bring energy to this movement from, say, the younger crowd. But I would also thank you for, you know, allowing me to do that and allowing me to do it much quicker than I might have otherwise. So, you know, very much thank you for that.
Well, you're most welcome, Happy, and again, a pleasure. We'll call it, we'll end it there. And I'm looking forward to interviewing you more and also others from the Wall Street Silver community, because there's a lot of very creative people and some really good thought patterns and a lot going on there. So plus we need some fresh blood. I think people are probably tired of looking at me and hearing me, although I'm very happy to do it with you anytime I'm asked. But no, it was really a pleasure. We'll have you back again, and just make a great day, and we'll talk to you soon.
All right. Thanks, David.